Okay, I believe we are ready to start. So good morning and good evening, everyone. It's 11 a.m. in London and 7 p.m. here in Singapore. And welcome to this session on the risk landscape, where we'll be reviewing how the world of risk has transpired this year in 2022 and trying to preview, get a peek into what 2023 could look like. This is hosted by the Systemic Risk Centre at the London School of Economics and also the Risk Management Institute of the National University of Singapore. So the questions are really for leading practitioners of risk from right around the world. We want to know, did we frame and approach risk in the right way this year? What has worked? What has not worked? What is it that truly surprised us? Are there things that we could be doing differently? What are some of the open questions that need to be studied more so that those joining from academia are able to explore some of those questions? We have a truly distinguished panel, practitioners at the highest level, and of course, our very own director of the Systemic Risk Centre. Before I introduce them, just a couple of housekeeping points. This session is being recorded, and the recording will likely be posted on our website afterwards. It's being streamed live on YouTube right now. Secondly, the hashtag, if you want to tweet about it, is hashtag LSE Risk SRC, LSE Risk SRC. We would very much like this to be as interactive as possible. Please use the Q&A box to ask your questions. You don't have to wait till the end, just put them down as they occur to you, and I will try and bring them in as quickly as possible. So now on to our panel. Let me go through a very brief bio of each one of them, and also to remind you, those in the audience, we have, I believe, a pretty healthy mix of participants in the audience as well. I think we have risk managers from the world of treasury, finance operations. We have people in risk controlling, operational risk and that sort of stuff. We have active investors, portfolio managers, asset allocators. We have regulators, policymakers, and we have students and academics. So those who are looking for subjects to research. So on the panel, we have John Daníelsson. John is a reader in finance at LSE and co-director of the Systemic Risk Centre. His research interests cover systemic risk, amongst many other things. His latest book, over here, I don't know if you can see that, The Illusion of Control, Why Financial Crises Happen, What We Can and Cannot Do About Them, has just come out. And he publishes regularly, and he's got a very active website, modelsandrisk.org. If you're interested, please visit that. We have Jean Frieda from PIMCO. Jean is Executive Vice President and Global Strategist at PIMCO, based here in London, serves as co-head of Foreign Exchange Strategy and also co-head of Emerging Markets Portfolio Committee. Before PIMCO, he was with More Capital, where he was a partner and a global strategist, also focusing on global macro. He has 28 years of investment experience, and very wisely, he has a degree from the London School of Economics, various fellowships and memberships of councils and so on. We have Virginie Maisonneuve. Virginie joined AllianzGI as Global CIO for Equities in June of 2021. In this capacity, she leads the development of the firm's equity capability and investment offering. She's a member of the firm's Investment Executive Committee, the International Management Group. She's a true leader in this space. I've known her from the time she was in Singapore. She has been in CIO positions across various top-tier firms and across the major financial centers. Some time ago, she pioneered investing in areas such as China, quantamentals, thematics, ESG, and climate change. And we have Pamela. Pamela Chu joining from here in Singapore. Pamela is partner at Control Risks, where she's also in charge of the Southeast Asia business. I've known Pamela from the time when she was with the Economist Group. She ran the CEO network for CEO Insights and Intelligence Service in Southeast Asia. And she started her career at the Ministry of Finance in Singapore. And also, very wisely, she has both an undergraduate and a postgrad from the London School of Economics. So that's the mix, that's the portfolio, very rich, very diverse, very distinguished. And with that, I would like to invite our panelists to make some opening remarks. Who should we start with? Jean, let's start with you, sir.
Thank you, Lutfey, and thank you for inviting me. I'll give the normal disclaimer. These are very much my own personal views, not those PIMCO's. To give you kind of a sense of how 2022 has played out, I'd probably want to make or highlight 4 points. The first one is the transitory inflation narrative dying on the vine, as it were, once it became clear that COVID's effects on the supply side and massive fiscal stimulus, especially in the United States, were generating second round effects. And so a defining feature of 2022 has really been central banks realizing they were behind the curve and rushing to catch back up. The second one occurred in February when Russia invaded the Ukraine. This was a second negative supply shock on top of COVID, but with a much wider set of consequences, and really putting some extraordinary risks on the list of investor considerations, things that we haven't really had to deal with, or most of us haven't had to deal with, if we're lucky, over the course of our careers. The first effect was just the compounding effect on inflation. We had a bad starting point, shocks beget shocks, and suddenly what was looking like a sticky inflation problem became a much more acute and sticky inflation problem. And the second one was it really created a new dilemma for Europe and the UK, a dilemma that's quite familiar to investors in emerging markets and policymakers in emerging markets, where you get a potentially permanent or semi-permanent supply shock that, in spite of weighing on GDP growth, actually requires demand to be managed down further. That's a very difficult thing, I think, for policymakers to understand. It's certainly a difficult thing to sell to politicians and electorates. And in many respects, the nature of the fiscal response has not helped the situation. It's made it more difficult. It's put more responsibility on central banks to compensate. The third aspect of the war in Ukraine has been the immediate response of financial sanctions. The financial sanctions on Russia at the outset of the war, I would describe as audacious, breathtaking, somewhat unimaginable. And they really generated this debate over, where is your money safe, particularly if you're a government or a central bank. And it prompted a discussion about the primacy of the dollar, whether the dollar's role was being undermined or reinforced. The nuclear threat became more palpable than at any point in the 1980s. How do you kind of weigh that in your investment considerations? It's something where you almost start to think about your exposures to certain assets in terms of wrong way risk. You may be bullish, for example, on Europe, but if you get caught in some kind of nuclear fallout, then, you've kind of got the wrong way. This became an existential threat to Germany's business model that relies on cheap Russian energy. We can maybe talk about more if we agree that threat is real or not, but I think that was a surprise of 2022. And then last but not least, the extreme uncertainty over terminal central bank policy rates, and especially the Fed's, as well as the commodity terms of trade shock that really redistributed income between, from commodity importers to commodity exporters. We think those are things that drove the dollar, the broad dollar, to its strongest level in 37 years. The third thing I would describe is really China's zero COVID policy. It's a central consideration today as they look to try to exit from that policy. But I think its persistence over the course of 2022 was something that started to create much more extreme stress in the property sector. It was already distressed, but that distress became somewhat more acute. Property, as many of you will know, has been one of the key drivers of growth over a long period of time. It forms the collateral bedrock of the financial system. So the questions over that, of the resilience or the strength of the property sector, became a central consideration. And the related point is simply that in keeping China locked down, there was a lot of Chinese spending that was locked in. China's current account surplus went up. That prevented, kind of the reopening spillovers of tourism to other parts of the region, the typical kind of cyclical upswing you'd see in commodity prices that would happen if China had exited that policy earlier. And last but not least on my list of kind of top four are what I would describe, paraphrasing Ralph Nader, is that safe assets aren't safe at any speed. And what we found was that in a world, that has sort of been built, an investment world that's been built on 60-40 portfolios of equities and bonds, suddenly bonds were a risky asset, not a safe asset. And so the cushioning mechanism that bonds would typically play in a portfolio became very different. And I think that also relates to two other sort of developments over the course of 2022. One is the fiscal constraints that we started to see emerge in certain countries. Without wanting to kind of push, the example too far, I think the experience of the UK, a lot of that shock in my mind came from the amplification effects of the pension industry, the LDI industry, suffering, a sharp rise in bond yields and having to delever very quickly. And so that sort of exacerbated what, was maybe a rather silly fiscal policy, but it turned it into something that was much more macro significant. And it became a demonstration effect for other finance ministers around the world. And then the third element of that safe asset discussion is really around infrastructure and regulatory constraints, which I'm sure John will talk about. And really sort of recognizing that, we still have a fair amount of fragility in the infrastructure, the plumbing of the financial system. And that infrastructure, I like to think of bonds as either playing a shock absorbing role in a normal world, or in this case, you kind of lose your shock absorbers and suddenly your ability to kind of manage bumps in the road, rises in volatility, uncertainty becomes much more constrained. So I think those are issues that have been relevant in 2022 and will probably be relevant in 2023 as well. Just to kind of give you my top four for 2023, the first one I would start with is just the question of inflation persistence. I think it's extremely likely that we will see a fair amount of disinflation just coming from softer commodity prices, a certain degree of central bank tightening. But we will get to a point at some point in 2023 where this question arises as to, is the growth sacrifice, is the employment sacrifice worth that last leg or that last mile of disinflation to get back to targets? Relatedly, it's very clear that the risk of new shocks to inflation are still very high. We know that it is a commodity supply constrained world. As they say, good things happen slowly, bad things happen quickly. Typically, we think of those bad things as being negative for growth. In this case, if they're both negative for growth and push up inflation, that will become a much more stark trade-off than it's been in 2022 when the growth backdrop has been reasonably strong. The second one is the terminal rate debate and the persistence of rates at very high levels. We're having a lot of discussions here on soft versus hard landing risks, and sticky versus less sticky inflation. There are also the secular stories of the green transition and decoupling from China, and what that means for neutral rates over the cycle. If we're working in a world where real neutral rates are much higher than they were in the pre-pandemic era, obviously that means very different things for countries and companies with high debt levels. And last, but certainly not least, what happens with fiscal policy? Will we have a fiscal soft landing in Europe? The rules continue to be suspended. Obviously, the demands of the climate transition, the war, are quite significant. And not unrelated to that will be the question of whether or not we get stuck in stagflation in certain economies like the UK. The third one is China-US decoupling. It's still not really clear to us what China will look like post-pandemic. If we consider pre-pandemic to have been what I call a 4+2 economy, 4% potential growth and 2% coming from debt-driven property-related growth, are we now in a 4% economy or a 4-2% economy? That really becomes a central question. And inevitably, we will continue to have this discussion about how investable China is, given all of the political pressures for decoupling. And then finally, sort of going back to this issue of safe assets not necessarily being safe at any speed, it's really the question about volatility. We've had exceptionally high volatility, high and rising volatility during 2022. Typically, one would not expect that to persist over the course of, the following year. But again, these become extremely important questions in terms of thinking about the resilience and robustness of the 60-40 equity bond, balanced portfolio, and really how safe assets are.
Right. Thank you, Gene. That's quite a lot on the plate. I have a couple of potential questions to ask you. I'll just flag them now, but I'll come back to you once I've done the circle. So I'm really thinking of fixed income and the yield curve, the inversion, the inflection, what happens there? So particularly the fixed income market. Is this the return of macro or the death of macro? I really don't know. Are we celebrating or are we mourning the opportunities out there? And emerging markets. We had in the extreme, we saw the Sri Lanka situation, but we also had Indonesia and India as the dogs that did not bark, to use a phrase. They performed really well. And I mean metaphorically, I just don't want to offend anyone with that phrase. So I'll come back to you with that. Virginie, if I may come to you now, ma'am, your perspective on how you see the risk world today.
Thank you. Very nice to be here today. So I'll start as Gene did, and a lot of the points that were made by Gene are in fact really points that I believe in. So I'll just go perhaps more quickly on 2022. I think the one of the of course underestimated risk was inflation and of course central banks, the unexpected risk completely being Russia. I think what of the thing that came out of it was the shift in national security for all countries around the world around energy and food. And I think in a world where technology and both in agriculture and energy prices were very low, I think that came as a surprise, as a consequence, but also had a lot of impact on governments' perception of risk and how they needed to plan for it. And some governments adapted faster than others, but I think that's a very important one. The second one is, of course, the adjustment, the rate adjustment, because of GFC and because, of course, of the pandemic, we've been on life support. And I think as Boulard said, the first 250 bips were basically just to normalize. I'm talking about the US. And now we're into a phase of further resetting. And I think that surprised the market, if you want, for having been on that life support for a long time. And risk always comes from those gaps between perception and reality by governments or market participants. And I think the gaps is what we need to identify. And the correlation, of course, of fixed income and equities, as has been surprising to many. But as we start this great reset, I see things playing out much better in that area for 2023. I think some of what surprised people also was the role of China in the Russian-Ukraine, staying as neutral as it can. And I'll talk about China more in detail in terms of how I look at the long term and some of my key themes, and as we move into 2023, so, what are the risks? What should we think about, right? So there I'd like to talk about short term and long term. Short term for me, 2023, if you want, next 12 months, it is short term in the sense that markets in equities tend to anticipate about 6 months ahead of time. So we are really at the beginning of 2023, but markets are already jumping to June, if you want, 23. So of course, as Jean mentioned, sticky inflation is the big question. And currently markets, they've gone through a couple of those relief rallies in equities, thinking that that's it. Of course, we knew that when you go from 75 to 50 to 25 bips, you're going to have those good news and those relief, if you want, because it creates a little bit more visibility. And as we've seen, the curve as inverted, and basically the market is saying that it believes that the US will be able to contain inflation and that we will get into a recession, at some point in time. But I think what probably is underestimated is the resolve from the Fed to really create slack in the labor market in order to really avoid an anchoring of inflation in the 70s. And that resolve is very important, because we're used to have the Fed somehow come and help the markets when things are a little bit tough. But in this case, I think the resolve around inflation uprooting is truly important. And so we'll have in that inflation picture, of course, cyclical elements. And as demand destructions unfolds and as recession unfolds, we will see the inflation part linked to the cyclical aspects, come down. But we have structural aspects that are supporting inflation, particularly around demographics, the green path, if you want, to the energy security in particular, and that is really important because it's still there. So it could be that the market gets disappointed by how fast they'll really see the peak in rates, and we may get longer rate increase, although at a lower level. So I think that's a risk for the market versus where we are today. Underestimating the speed of tightening. So the speed of tightening is something that's, I think, puzzling central banks and the market in a way. We know that it takes 4 to 6 quarters for things to work through the system, and therefore anticipating that the work is done, I think, is a mistake, because we will see the impact, delayed, and because of the structural factors, could in fact have more of an elongated cycle here. But if you look at the lead indicators, if you look at confidence surveys, we know a sharp adjustment is coming, which leads me to my next point. If you look at earnings estimates right now, because of the low visibility, they're quite benign for 2023 for stocks all around the world. And the risk might be that they need to come down quite sharply from here because of this abrupt adjustment that the lead indicators are talking to us about. As we know, if we want to have slack in the system in the US, an employment rate of maybe 4.5% or even slightly higher is needed, and we're at 3.8. Finally, I would say for 2023, as Jean mentioned around the LDI issue, or even some of the other bubble bursting that we are witnessing, we know that when free money is handed in a large scale to a large number of market participants, there are unintended consequences when regime shift happen. And I think we're due to see one of those in 2023 and should be prepared for it. Looking beyond 2023, I think the thematic framework is really important to keep in mind. I'll start, by what I call China phase 3. I believe China is now entering its third phase of maturing. in the modern world, if you want. The first one when she joined WTO and became fully integrated in the global economy. The second one when she became larger than Japan after the GFC, and now being, in the past 4 years, and it's about geopolitical power. It's about soft power. It's about maturing its growth profile and its added value. As we know, that's been an effort, but also dealing with a table that's quite narrow at the top, and those regime shifts again are always quite difficult to handle. So I think China phase 3 will continue to be a source of volatility in the decade to come, particularly when combined with my second theme of digital Darwinism. And it is linked to China in the sense that I've never believed that the US trade war with China was linked to proper trade, if you want, but always about technology. And,
sorry to interrupt you, Virginie. Did you say digital Darwinism?
Yes, digital Darwinism. So I'll explain what I see by that. I see the technology being connectivity, machine learning, AI, and of course platforms and the next generation of internet, creating an environment, an ecosystem where the speed of acceleration will be very strong in terms of enabling or hurting competitiveness. And it is both at the geopolitical level as well as the company level. So in the case of China, and China has a strong competitive advantage in digital Darwinism because it has one of the largest internet users based in the world. It also has access to a lot of data in a way that other countries may not be able to use it. And as you know, data is the key to machine learning and artificial intelligence. As a result of this digital Darwinism or this digital war between China and the US, which is really about the top spot, right, in the global economy and geopolitics, I think that China has met resistance, of course, in technology transfer, and as a result, as we know, is relying more on own resilience and self-sufficiency and developing its own systems. But I have no doubt that China's innovative power is vastly underestimated. The second thing is really about how that is also a source of volatility around the world. My third major themes thinking about volatility is, of course, climate. This is a theme that I've talked about for many, many years. And I think, the COP27 results were actually quite disappointing. But perhaps it is a reflection that we need another engine for bringing everybody together for action points at a global level to resolve climate. I believe that the pandemic was actually a blueprint that's going to be very important in how we deal with climate, but we know that climate is going to be very disruptive and, of course, a big source of risk, from property to insurance. The whole 100 billion loss event is now happening, every year, basically. And a lot of participants, change in interest, talk about migration, talk again about food security, talk about energy security. So climate is now, I believe, at a tipping point. And I'm happy to talk about it more in detail later, but it is a 10-year cumulative process and is a very, very large supertanker to move around. And that acceleration is truly important for us. I would say I have two other themes, very lightly: supply chain changes, which of course are bound to be somehow disruptive, somehow inflationary if you think of onshoring, but also redesigning supply chain around trust lines. I think that's still underestimated. And of course, the impact of rising rates as a trigger for more volatility and where the tipping point is going to be. So I'll stop here and look forward to hearing the other speakers as well.
Thank you so much, Virginie. That was again a treasure trove of things to ponder. I think just going back to your earlier comments about the US and the Fed and the absolute reason to not let anchoring inflation expectations to anchor at a point where it's not possible to dislodge. I will ask you when we come back very quickly to answer whether you think therefore a hard landing is a given. So, I think Gene was sugarcoating it. He was saying maybe, maybe not, but whether you think it's a given by design, it has to be a hard landing in order to not have expectations take hold. But I would also like for you to please not only extend your comments about energy security and how this ESG backlash might play out in the next 12 to 18 months, but also Japan, given your time spent in Asia Pacific. So I'll come back to you on that. A very important economy, Japan. We'd like to spend a bit of time on that. If I could come now to Pam Chu. I'm sorry, I should have also mentioned that Nasreen Kasenally, who we were expecting here from UBS, is unable to join. She sent us an email a couple of hours ago, very unwell. She's practically lost her voice, so we wish her a speedy recovery and hope that she'll be with us next time round. The UBS, I've been looking at some of the outlook presentations from the various sell-side firms, and I thought the way UBS framed the way things are going is interesting. They said if 2020 was the year of infection, 2021 was the year of injection, 2022 is the year of inflation, then 2023 is the year of inflection. So maybe we'll touch on the year of inflection soon. But switching gears, Pam, you're here with me in our time zone. Your perspective from here, please.
Thanks very much, Lutfey. And just picking up on your last theme there, if I review 2022, actually, I think that it was a pivot in terms of risk landscape. If you consider 2020 and 2021, the world was generally fighting against the pandemic. So a lot of the issues that companies and countries, households were facing had a common theme in them. I think post-pandemic for most of the world, of course there are pockets like China where we're not over that, but the landscape does look different. If you look at the public enemy number one in the US, it's exactly all the themes that the panel have discussed already today, which is the inflation that starts the unraveling. And if you look at Europe, inflation is definitely part of the picture, but the fundamental kind of anxiety is really around the land war and the spillover effects of the Russia-Ukraine conflict, the biggest one since 1945. And then if you come to Asia, if you just take China, the biggest public enemy number one there is the housing market and the fallout of the dynamic zero COVID policy. And if you look at the rest of Asia Pacific, they're also very concerned about the China proposition in the next few years and what that means for politics as well as the economics of the region. So China being a major investor as well as a major buyer into Asia Pacific, what does that look like in the next 5 years? And on the other side are the opportunities that the region can capture because companies and governments are thinking about decoupling between the US and China, but also with other blocs, right? So AUKUS, for example, Australian, UK, US relationship that has come out only in the past last 12 to 18 months, and that has been quite critical in terms of how Australia companies look at the landscape of opportunity into the US and into the UK, when 10 years ago it was quite unthinkable that Australia and China would go head to head quite publicly with disagreements because those two economies were so closely tied on very major exports, and they depended on both of, well, there was a mutual dependency on the commodities boom. But today, I think Australia, because of its alignment and its support from other Western nations forming a bloc, they have become a little bit more bold and forward-looking in terms of what they want that geopolitical relationship to look like. So I do think that 2022 has been a change in the way that companies look at risk, because if you're a CEO of a company, you now have your regional heads all over the world telling you somewhat different stories of what you as a global CEO need to be concerned about. And we see this in the people that we work with, kind of that prioritization of what is more important. Do I think about the decoupling issues first, or do I think about the inflation picture first? I think those kinds of priorities have kind of become sometimes, not say in conflict, but they have to be looked at from a holistic perspective. And it's no longer sort of this common goal where I just need to make sure that I'm set for COVID and also the rebound after COVID, which was where everybody's head was in 2021. If I come now to kind of the current risks that we are looking at that will spill over into 2022, the first, and coming here from an Asia perspective, I'll say that's from an Asia perspective, top is really geopolitical. So people my predecessors on the panel have already touched on it. So US-China decoupling. I think when Nancy Pelosi visited Taiwan, phone was ringing nonstop. People are really worried about whether or not this is the start of a possible military kind of conflict, at the start of that at least. And what we constantly try to remind people who listen is that we believe the invasion of Taiwan is still very many years away. It's not possible to come, I shouldn't say never is never, but it's not really a priority on anyone's list in the Chinese government nor in the US government to allow something to happen. Of course, there is a risk of possible miscalculation and trigger incidents, but generally people are not motivated to think about invasion. However, there are going to be many other scenarios for companies and governments to think about in the lead up to a more adverse relationship between the two. And we saw that as well in sort of the Nancy Pelosi visit, where there were blockades in the straits and there were grounding of flights, and these caused a lot of supply chain issues. And we know, of course, that China and Taiwan are a critical supply chain for US companies and other developed companies who are looking at chips. And there are other ways where this relationship can take on a fight and cause a lot of pain for corporates. That includes regulations, so things like the CHIPS Act, to prevent the Semiconductor Act from the US, to negative lists in China. So how do you watch that? Are you going to be a target of those regulatory penalties? That's all very plausible. It does sit under continuum of a deteriorating US-China relationship. But it's not sort of the war scenario, right? People kind of tend to jump to that and say, are we at war? And then the US, when Biden and Xi Jinping meet and say, nice things to each other, kind of everybody kind of feels a sigh of relief, and it seems to have gone off the radar a little bit. But the reality is the underlying risk of tension between the two countries is not going away, and a lot of these small operational things do feed up into big pain for corporates. The second thing I'll highlight is the energy disruption transition. So I know we've talked about this as well, previous panelists have, but to highlight the A perspective, I think one thing we're really watching is how prepared governments and companies are for tougher regulation from developed markets, which they service and they export to and they supply to, having strict coming down quite strictly on their exporter or their supply chain around filling some of these obligations for ESG.
Sorry, Pam,
a lot of the Asia landscape is self-reporting. No one's kind of really enforcing.
Sorry, the line is.
Am I back?
You are back. You froze for a little bit, but you're back now.
Okay. Oh no, sorry. Okay.
So, we heard the point about.
Do let me know if.
Sure, we heard the point about Western regulations around ESG impacting suppliers from Asia, and how prepared or unprepared people might feel here.
Great. Well, I hope this is this line clear?
The line is clear now, yes.
Perfect. Yes. And that is, I think, a big issue that a lot of the corporates need to think about, because at the moment it's still kind of from a self-reported, self-regulated, targeted approach where you report on what you can against the plan that you self-declared. But when the time comes where, like, the palm oil sector is being asked to demonstrate a certain level of quality in terms of used palm oil or things that feed into the renewable sector, that's going to come into downstream for many other sectors who might not have got quite clear goals around that. And then the third thing I'll highlight is fraud. We say at Control Risks that when interest rates go down, fraud tends to go up because cheap financing hides a lot of bad behavior. But when interest rates go up, as in the context that we're all in now, fraud tends to come out for various reasons, because they can't hide behind cheap financing, but also because regulators seem to also need to find the budget to fund stimulus programs, and so they go after corporates to find them and sort of beef up their balance sheet somehow. And we're seeing that, or we anticipate that a lot of clients will be coming to us to investigate disputes across partners, and finding out that in the heyday of low interest rates, they allowed a lot of fraudulent behavior to thrive. And then on the extension of that, the regulatory risks across sectors in the context of a slower economic environment. We're expecting kind of things to tie back to the geopolitical issues that we raised. Things like technology sector will face more data protection laws, global minimum tax rules, trade controls. All of that has some geopolitical motivation behind it, but now turbocharged because the economic environment is difficult, and so all countries need to start fighting for a piece of that pie that tends to be either shrinking or stagnating. There are many other things to talk about, but I'll stop here.
Thank you so much, Pam. I was very keen to, and I'm very grateful that you brought up that perspective of the real economy. These are business owners that you deal with, and whereas the rest of us, we're looking at it purely from a finance point of view. So it's very useful to see what real risks look like at the level of operations. Pam, the question I'm going to come to you with is on geopolitics. If you are a business in a third country, so not the US or China, maybe somewhere here in Southeast Asia, do you have to choose sides? Do you feel you're being forced to choose sides, or is it possible for you to have both operating systems, in two pockets, so you switch from one to the other and keep a foot on each camp? Is that possible, or is having to choose a real risk for businesses over here? So I'll come back to you with that question. And now, last but not least, John Daníelsson. I should have mentioned that the book, The Illusion of Control, just last week, Martin Wolf from the FT flagged it as one of his books of the year in the economics and finance category. So congratulations, John. Let's have your opening remarks, please.
Thank you so much, Lutfey. It is certainly difficult to come after all these excellent presenters who highlighted the risk threats we are facing today and in the coming year. But unlike them, I'm an academic, not a practitioner, so I take perhaps a more abstract academic long-term view. And to start with, I would think risk is not about what has happened already. Risk is about what may happen in the next year and in the next decade. And almost certainly, that risk is not something we are looking at today. So we almost by definition miss what is important. And the key, therefore, when I use a more abstract analysis, I think systemic risk, the chance of a major crisis, is higher now than it has been for a generation. So we are certainly heading in for a fairly choppy times if it comes to fruition. But of course, systemic risk is not about the likely, but what could possibly happen. And a key ingredient in all of that is that the risk we care about is almost by definition not the risk we measure. The day-to-day, the month-to-month, or even the year-to-year is practically irrelevant for most people. We care about our pensions paying out in 50 years. We care about a major bank collapsing. We care about a major financial crisis. The day-to-day risk is just not all that important for most of us. But that's where the data lives. So if you look at the distribution of outcomes, the big tail events, where the big, huge upsides and huge downsides, they live in the tails. The data lives in the middle. And in the middle, where we all have all the day-to-day risk, that's where we apply all our statistics, algorithms. That's where machine learning is let loose with AI governing it. And we get really good at measuring and managing day-to-day risk, which is the risk we don't really care about all that much. The risk in the tails is practically unmeasurable. And therefore, the illusion of control, as in my book, is when you focus so much on the middle and the risk dashboards all tell you what is going on, the risk dashboards almost by definition are lying to you. What governs the tails, and the bigger the events on the upside and the downside, the driving factor of politics. If we look at what is causing, what driving risk, has driven risk events, from beginning of time until today, and most likely into the future, it is politics. Brexit, Trump, we have the pending systemic crisis in Italy, we have the real estate crisis, the inability to deal with the environment, as so many of you mentioned, is entirely due to politics. The demographic challenge, why we can't deal with that, is entirely political. But how do you measure such risk? If we all put our heads together and say, let's make up plausible political scenarios, well, we can find so many scenarios that all we end up with is paralysis by analysis. So therefore, when it comes to thinking about how society, I'm the academic, not the practitioner, so I think about society, should think about risk, and what I argued was the highest systemic risk in a generation, it's all about risk shock absorption. How can we absorb the shocks that come our way? And that's, I think we have gone the wrong way in shock absorption. The way we think about it now is we measure day-to-day risk, the wrong risk. We use that to build big capital buffers. And then we try to make the buffers so big that if something really bad happens, we can sustain it. The problem is you can never build a capital buffer big enough to sustain a big tsunami coming your way. But equally importantly, in doing so, the financial authorities in every country in the world, they harmonize the way financial institutions see risk and react to it, because that's what regulations takes you towards. And that means when a shock happens, everybody is forced to buy or sell at the same time, amplifying the shock going up and down. That drives systemic risk. From a policy point of view, it's much better to aim at shock absorption. And shock absorption is a really simple thing to achieve, because if a big shock comes, if somebody buys and somebody else sells, then you absorb the shock. You transform a shock into random noise. And the way to do that is to make the institutions of the system diverse. The more different they are, the more differently they see the world, the more differently they react to the world, the more resilient the system becomes, the more better we absorb shocks. And it's a win-win for everybody. We can lower the cost of regulations, which help with economic growth, and we achieve more financial stability, which benefits us in the long run. But we are going, I think, in the wrong direction with all of this. A key reason why I maintain systemic risk is higher than it has been in a generation. And now off to you, Lutfey.
Thank you, John. That's that is, I'm not sure whether I feel good or bad about it. I guess not good, because if systemic risk is at an all-time high and capacity for shock absorption is at an all-time low, that's not the best combination. When I come to you with a question, John, could I shift gears a little bit before coming back to this? And that shift is going to be about something that no one has mentioned today, and that is about crypto, the world of crypto currency, or whatever you want to call it. I saw you wrote a blog. I confess I haven't read it yet, the beginning of the end of crypto. It'd be great for us to hear you elaborate a little bit on that, please, because it certainly is on the risk radar right now. So we'll do a round of questions now with the panel. I see that the Q&A from the audience is also coming in. So a reminder to you, the members of the audience, please put your questions in the Q&A box, and we will put them to the distinguished panelists. So Jean, let's come to you, please. The yield curve, the shape of the yield curve, what do we do? Because I hear between the views from the equities world and the fixed income world, I hear that, look, we need some clear signals that things are going to turn around. It's not time yet, so just sit and wait. What do we do with cash while we sit and wait? Do we lock it up for a couple of years, or do we really put it in the very short end and wait for something? How do you see the yield curve evolve from here on?
Right. Okay. Thank you. And I just wanted to say that the comments from the other panelists were fascinating. So thanks for bringing us all together to share all of these perspectives. I think one thing that we all struggle with right now is how tight financial conditions are. And that kind of goes centrally to your question about the inversion of the yield curve and how tight, is a minus 50 basis point 2s10s curve today the same as it was 10 years, 20 years, 30 years ago, when you had, what I would argue was a world of higher macro volatility, higher inflation uncertainty, higher growth uncertainty. I would posit that they aren't created equal, that financial conditions are certainly not that tight today. The delta has obviously been, the change has been, rapid this year. But I would say that from that perspective, the yield curve is telling us only where we can be confident is in saying that things will slow down. We cannot be particularly confident in saying that there will be a soft landing, a hard landing, and I would actually attach roughly equal probabilities to both scenarios, which is one thing that makes, kind of having a strong conviction view on the outlook from here. Both scenarios are reasonably plausible right now. I would say that, if one thinks about, coming out of a shock like this, and by a shock, I mean the confluence of COVID, the rise in inflation, the compounding effects of the war, the fiscal response to the war, it's very clear that the private sector has emerged from these shocks pretty robust and pretty good shape. And so their ability to handle a certain set of conditions, tighter conditions, is higher today than it will likely be in a couple of years when these longer term questions of high debt levels come back to the fore, when the benefits of all the refinancing that took place over the last few years start to fade out. And so it will require a fairly nimble set of central banks to respond, to that transition from a world a private sector that can probably stomach much tighter conditions in the short run to one that probably can't over the medium run.
Right. Okay. Would you like to take the second question right now, the one about emerging markets? EM as an asset class, how are you looking at it now for next year?
Yeah, I mean, I would say that this is a classic case of macro versus markets. Keeping in mind, obviously, that the EM asset class, is probably poorly named. It's a misnomer, given that we have countries, that are extremely poor and extremely rich in the same asset class. So, I mean, the diversity of what you can do with an EM, I think it's dangerous to talk about it as a singular asset class. But to the extent that we think of it as an asset class that's dominated by, commodity exporters or producers of manufactured goods, I would say that the macro side of it is not very encouraging. There is no reason to think in my mind that the cost of finance will continue to be reasonably high for these countries, and that the growth models are sort of open to question. And these questions about the green transition and decoupling between China and the rest of the world, or the West at least, those are generally things that are not good. There may be some substitution effects for certain countries, but the income effect will generally be negative for these countries. But against that, you have the market side. And the market side is, to use your sort of to leverage off of your UBS and injection, inflation, inflection. I would describe the last 10 years in EM as kind of immolation. We've had a 10-year run of really since 2013, and after the taper tantrum, of deleveraging from EM, weak growth outcomes, commodity price shocks that were generally harmful. So from that perspective, there's not a lot of exposure by international investors to emerging markets. And so you can start to make arguments about portfolio diversification, greater resilience to external shocks, just coming from the fact that if a shock hits outside of EM, the money that gets pulled out of EM is just, there's not much to pull out anymore. Right. Real rates are relatively high in certain countries. And so, I could still see the asset class doing well, particularly off of a weaker dollar environment. But I think we need to make that distinction between markets on the one hand and macro on the other. And then there is obviously that subset of EM that has become extremely distressed. These are the countries that have typically been, they have not made that transition from borrowing in dollars to borrowing in local currency. A number of those countries have already defaulted. Some of them are on the verge of default. We don't really see any reason why they will get much relief in 2023.
Right. It's an interesting point. I hadn't thought of the fact that, a lot of people were not invested in some of these EM going into this round of the crisis, which is probably why you've seen a lot of the sell-off in the currency market against the dollar being greater against the developed counter currencies than the EM counter currencies, which brings me to Virginie quite nicely, Virginie, because the Japanese yen and Japan is something I'd love for you to comment on. But before that, ESG and climate risk. Are we now in the Empire Strikes Back sequel to Star Wars, where the climate camp thought we had won, and now the backlash is here? Is it here for good, or do you think this is just a bit of a blip?
Well, I think you have to go back to basics, right? So what we know is if we don't do anything, we're on a 2.8 degree increase path. If we abide by the Paris Agreement, we're on a 2.6 degree path. If we abide by the current commitments for net zero, we're on a 1.8 degree path. Of course, all of those are estimates. In any case, as we know, 1.5 degrees increase is what we were looking to achieve. And at 2.8 degrees, the world looks like a very different place. Ocean level rising. We have to remember in Asia, ocean levels are rising twice as fast as in the rest of the world. You're talking about crops, you're talking about migration, you're talking about available habitable land. And of course, from a financial standpoint, you're talking, as we briefly highlighted, valuation of assets, et cetera, et cetera. So to me, it's not because oil prices and the energy sector has been basically up to recently, the only one that outperformed, that we need to drop the long-term ambition to create a stable environment for the planet. I mean, that's very clear. I think what's going to happen, though, is you will see an acceleration of regulation. And what's really interesting to me, and I've looked at that theme for most of the past 25 years, right, is the acceleration in Europe, in particular, if you look at MiFID, if you look at SFDR. And of course, those regulations are, in a way, they come in, they're a bit clumsy. People are learning at the same time. But my sense is that if you looked at Europe versus the UK, now the UK has put in their own regulations. We'll see over the next decade, because of that imperative, much more regulation taking place around the world, not only in terms of what you can invest in, but also in terms of what you must declare and what you must measure. And there, I go back to artificial intelligence, because to me, technology and artificial intelligence are the only thing that can really help us. Part again, it's demand destruction is one thing, of producing better, finding new sources of energy, finding ways of accelerating renewable. So be it, it takes on average, I think, 6 years for renewable energy farm or plant, to be put together from start to finish in Europe. That needs to be reduced drastically, because a lot of it is administrative processes. I think we'll see that shifting. And again, thinking about new competitive source of energy, but remembering that the problem is truly holistic at the global level, and that we're going to need to find new ways of working together. So I think that's the first thing. And to me, people who are just looking at this 1 year as, climate and ESG and sustainability are dropped, I think are about to make a huge mistake.
Can I just a quick follow up on that? So if I understood it correctly, you're saying that you had said earlier that we need a new thrust to give it a bit of a ballast in the way that the pandemic provided a bit of a thrust earlier on. And I think you're saying that this new acceleration of regulation would probably give that push. Do you not see that attempt at new regulations hitting an immediate political pushback? I mean, we saw even between the Liz Truss government and the Johnson government and the Sunak government, huge changes within the same party.
Yeah.
Onshore windmills, yes, no, things like that at a minute level. Do you see regulations still cutting through all of that?
Yeah, I think I do. And you're pointing to a very important point, which is a mismatch between the way we need to solve climate and political cycles, which tend to be very short in nature, 4 years, 5 years. And this is the problem that we've had, as well as the mismatch in development stage between different countries in the world. So if you look at accumulated CO2 from the developed world, particularly the US versus China, although China today clearly is a large emitter, if you look at it since the Second World War itself. So all of those are creating frameworks that are very, very hard to find, I would say, the concept of fair solution. What I'm saying is, with the tipping points, at some point, it's a little bit like the pandemic. In crisis mode, the world will have to come together. And one of the encouraging things that I saw from COP27 is this idea of creating funds to help economies who have less means to combat climate, to actually try to find that solution. But the problem is not going away, because politicians are fighting over where you put a windmill. That is not going to be the case. The carbon is there, and we need to change the way we do things radically. It's about circular economy. It's about systems thinking. It's about all of this. So, I think over the next 10 years, we will see a lot in this area.
Okay. I think that also answers one of the questions in the Q&A box from Arun, his question. So Arun, I hope that also answers your question. Japan, Virginie, before I move on, if you wouldn't mind giving us.
So thank you. We were talking about risk, and I think one of the perhaps underestimated risk is the fact that Japan is the largest creditor in the world. Japan is the largest US Treasury holder in the world, ahead of China, with, I think, the latest numbers I saw was 1.2 trillion. It has over 3 trillion of foreign assets. And the question that I have, and I've not seen much on it, but I'm very interested in the topic, is with yields, of course, coming back up now, even in China, even in Japan, and inflation picking up a little bit, with the reopening trade, which, as you know, wage growth in Japan has been anemic for many, many years, right? If you had a shift of regime there, I'm not making a forecast, but if, and you can see how there's a domestic attractiveness, because hedging the yen, is more expensive now. If you look at dollar yen, right, it's possible that you could have a reversal of assets. And I think at this point in the world where we have a lot of tightening, and one of the fastest tightening we've ever seen, this could be a source of risk. I don't have an answer to the question. I'm just raising it as a risk that people don't talk too much about.
So just so that I'm clear on this, if that materializes, does that mean a selling of US Treasuries held by the Japanese, and therefore selling of the dollars and buying Japanese yen, and therefore a snapback in the dollar-yen exchange rate?
It would have an impact on currencies. It depends on the scale, of course. And it's not only about US Treasury, it's also assets, right? So we have to see how much assets are short-term versus long-term. I'm not anticipating that Japan would divest for all those long-term holdings that have, but if you had meaningful capital flow back into Japan, of course it would have an impact on the stock market in Japan. It would have an impact on the currency, but it would also have an impact on flows around the world at the time where the system is quite tight.
I see.
And I do not have numbers. This is not a forecast. This is a question that I think we need to explore more in terms of thinking about risk. And given the topic of the panel today, I thought that was interesting.
Thank you. So potential rehoming of capital, Japanese capital, a large amount of which is outside of Japan right now. Pam, sorry, I need to adjust my screen to make sure I see you. There you are. So the question of choosing sides. Is it possible to choose sides? Is it a risk that we might be forced to choose sides between China and the US? What's going on here in Asia?
Thanks very much, Lutfey. Maybe if you don't mind, I would like to just touch on Arvin's question as well on ESG, just to agree fully with Virginie's comments. But I think to add that from an emerging markets perspective, I think the just transition, which I think was probably covered in the report that you mentioned, financing the climate agenda, would have tackled, right? So just transition and making sure who pays for it is answered. So we saw a little bit of that in COP27 with loss and damage. But I think an important element to add here is also that the large developed countries are concerned about domestic sentiment. They are elected by citizens within their boundaries. And until those citizens really rally up and fight for things like just transition, I think it's going to be very difficult for political leaders today to chart forth that path without domestic support. Right. And that, if you apply the same point to companies, actually the biggest motivator or driver of a ESG agenda at companies is their people, is employees, right? Activist employees, maybe, but also the younger demographic who are pushing for a values-driven approach to work. And that runs alongside the regulatory piece. And I don't think regulatory pieces can solve everything, because it just becomes a box-ticking exercise in many cases. But if we have the momentum from employees to pressure their company leaders to make the change, then we have some form of hope. So it's kind of the domestic. Who are the leaders listening to? In the governments, it's their domestic constituency, and in companies, it's their people and their talent. Right. So just a bit on that. So on your question, I think it's getting harder and harder and harder to choose. It's not just about choosing, right? It's trying to play off each other. So, if you're Indonesia, for example, you're trying to court the Chinese investor, you're trying to court the US investor. It's not just trying to make sure you don't say the wrong thing, but actively get them to pour money into your market. It's going to get just harder and harder. I do believe small countries tend to get away with it, I suppose, or maybe they either have chosen already, or like Singapore, it's still possible to try to toe the line. But if you are Indonesia or you're India, that's a whole different ballgame. If you take what Indonesia wants to do with its economy, that it's about capturing the energy transition opportunities. So there was, Jokowi's out shouting in the market that he wants Indonesia to become the global base for EV battery capacity, for example. And he's courting everyone from Japan to China to the US and Europe to have those car makers put their battery capacity manufacturing in Indonesia. Up to a certain point, it's going to come to a head where, if you've had some kind of geopolitical incident happen where the US then turns against China, or it ratchets it up, say, in the worst case scenario, we do go up into a military conflict somewhere down the line, it's going to be very hard for Indonesia to say, well, I'm just going to stand on this, I'm just going to stand in the middle. And they will have so much to lose. And I think in terms of Indonesia's potential and the risk, it's exactly that they have the potential to be able to capture all of the fallout of the decoupling supply chain movement, but at the same time, they're then caught in this really tight tightrope where they have to walk and they have to make sure that they manage that well. The interesting point is that if just on Indonesia, Jokowi's met, I think maybe you know this already, but Jokowi's met Putin, Zelensky, Biden, and Xi Jinping all in 1 year. Yeah, and no one else has done that, really. He personally went to invite Zelensky to the G20 meeting, but got turned down and got kind of shooed away. But the fact that he's making such a big effort to try to balance out that Russia was invited to the G20 is a signal that he's really trying very hard, but there's really a limit to how this can work.
Yeah. And Narendra Modi as well. He's met him also in the same year. Thank you, Pamela. John, I'd like to come to you now, but Virginie, just a heads up, there is a question that has been upvoted that is aimed at you, so I'll just draw your attention to that, which is the digital Darwinism. Is that similar to Neil Ferguson's notion of a game-changing innovation lead, which may result in a new governance arrangement globally? So that's the question for you. But before that, John, again, looks like in addition to my question on crypto, there's a couple that you need to address. And the two are similar. One is, can you please explain further about capital buffers and why you believe that they're not sufficient? And two, all right, so we have procyclicality, Goodhart's law when it comes to liquid assets in the context of macro-pru, everyone sells at the same time. Maybe the LDI incident earlier this year in the UK was similar to that. The question is, what do you think could be a solution to this from a policy perspective?
So you also want the crypto question answered, Lutfey?
I do want the crypto question, so briefly on these two, please.
Let's do the crypto first then. So basically, I think the reason why Lutfey asked the question is that I had a blog piece this morning on voxeu.org that had the rather provocative title, The Beginning of the End for Crypto. And the reasoning is that what drives crypto is the political mission with what I call the foundation myth of a sort of new technological nirvana that is supposed to deliver us a better world, better financial world than the one that we have today, what they call the old school financial system. And that political mission is critical to crypto success. However, what drives crypto prices is speculators who couldn't care less about politics. And the speculators is the vast majority, but the politics is what gives them legitimacy. Why, in a way, why crypto is not a Ponzi scheme. And what I was arguing is that the FTX scandal and a few others recently, what they have shown us is crypto has now joined the mainstream financial system. They comply with KYC and AML and sanctions. They are increasingly regulated. They are seeking micro-prudential norms. So they are giving up the political mission in joining the mainstream. Meanwhile, the price of Bitcoin today is the same place it was 5 years ago. So therefore, my argument was that because the politics has been undermined, the foundation myth is being eroded, And because the speculators no longer see the advantage of crypto, therefore it has started its inevitable decline phase. So it's the beginning of end. It will be a long, interesting ride, but it's sort of the beginning of the end for crypto. And ultimately,
Right.
This means crypto is not a public concern. It is not a threat to financial stability, and it's not a threat to microprudential concerns. So therefore, just let it be and just enjoy watching it decline slowly.
Right.
Yeah.
Just I was going to say, I agree. From a contagion point of view to the rest of the financial system, there doesn't seem to be an issue so far. There is a contamination, though, of standards. The fact that you don't need to do the kind of due diligence in crypto land, apparently, that you need to do in the real world, or you don't need a board of governors, board of directors, whereas you do in the real world. The degradation of standards of investments may have been a spillover from what's going on in that world, and maybe that should not stay over here. Would you like to take the other questions?
So the question about capital is that what I said is slightly different. I said the capital is the wrong solution to the problem. Bank capital is very high, hitting from some of the major banks 18-19%. And the problem is you can never make capital big enough to withstand a major crisis. So therefore, regardless of whether your capital at the current 18%, or you make it 40 or 50%, it's still not going to be sufficient. And capital is a very expensive way of protecting the system. So instead of forcing banks to hold high amounts of capital, it'd be much better instead to find alternative ways to achieve financial stability that do not require capital. And in that, my solution is to increase shock absorption capacity to make the financial system take on shocks rather than the current arrangement, which is effectively amplifying them. I think that's I hope I found the... So
banks holding capital is not part of the shock absorption capacity of the system?
Well, the problem is a buffer is meant to take on a shock when it comes along, but the problem is the way you calculate the buffer makes the buffer a shock amplification device, because a bank has to hold the buffer no matter what happens, and the buffer has to be calculated in a particular way. So therefore, because you have the buffer, you force banks to measure risk in the same way. You force banks to react to risk in the same way. And that means when the shock happens, the banks will end up selling at the same time or buying at the same time the same assets. This amplifies shocks. So the presence of capital buffers as currently conceived, they work as a shock amplification device rather than a shock absorption device.
Okay. All right. Thank you, John. Virginie, would you like to take that question about digital Darwinism?
Yes, so I haven't read the book that's mentioned in the question. I can explain what I mean by digital Darwinism. So Darwinism, as we know, is survival of the fittest, and I believe that because of the technology cross points that we are seeing, as we mentioned, hardware, software, connectivity, AI, machine learning, and to a certain extent quantum, but those technologies are really at the core of it, that this enables productivity gains and other kind of competitive advantages. But as technology permeates all sectors of the economy, they're actually really becoming not just the tech, it's what I call XXX tech, right? So within that means that you have new competitive advantage or disadvantages, not only at the country level, so hitting on geopolitics, but also at the company level. So, you go back to the old bookstore and Amazon being sort of the first step of that evolution. But think about even the financial sector, think about the Internet of Things and how it's going to transform the insurance industry. Think about quantum technology and, weather prediction and climate change, so solving very large, problems, but also in terms of delivering services, in terms of creating new products. When you see how artificial intelligence was used and the platforms that were used to develop the vaccines that we currently have, the role was instrumental. So we're saying we're moving to that next phase, and that next phase, bringing competitive advantage, will also create competitive disadvantage, and there'll be very strong losers and winners. That's what I mean.
Got it. Thank you. A couple of more questions in the Q&A box. So we're also coming towards the end of our time. I'll paraphrase the first one, which is about muscular diplomacy. Does anyone on the panel feel that Pelosi's visit to Taiwan was a good idea?
Yes.
We have one yes. Would you like to elaborate, John?
Of course, and I think the people who say it's a bad idea, they don't know their history. When Taiwan was essentially pushed out of the UN and China gained entry 50 years ago, the United States promised it would guarantee the integrity of Taiwan and protect it against all aggression. So therefore, if the United States is not able to honor that commitment, then the world will be a much less safe place. What Nancy Pelosi did, she simply reaffirmed that the United States is continuing to adhere to the agreement it made to China in 1974, and China agreed to at the time. I don't think China should be complaining about it. They should just recognize it. They agreed to this 50 years ago, and that's what Nancy Pelosi did today. I mean, I think I'm fully in support of what she did.
So you really think that she's underlined that the US will come to the rescue of Taiwan if possible? Or do you not think it's just the equivalent of your capital buffers, false sense of security?
No, because so if you follow US politics, the US domestic politics, continues to reflect very strong support for China in case of for Taiwan in case of Chinese aggression, and the United States needs to reaffirm that, because if the United States does not come and reaffirm the support again and again and again, China is likely to continue to push and push and push. So therefore, this draws a line in the sense saying we are honoring our commitment from 1974. And I think she was exactly the right person to do, and she did it perfectly well. I mean.
Okay, I've got one more question in the Q&A box. Does anyone else want to comment on this point? Nancy Pelosi, Taiwan, China, US backstop, security guarantee reinforced or otherwise? Jean is itching to do. Yeah, sorry, Pat. Go ahead.
So I wouldn't want to comment on actually whether it was a good or bad idea. I would say that it's inevitable that these happen, that U.S. powers might want to prove or show a point. I would say, however, that because of the electoral cycle in the U.S., it is a very dangerous thing to do when you don't have that continuity of policy. So if we come back with a Republican government in 2024, which is actually quite likely, what would that approach be? And who are the losers in this situation? It is the Taiwanese people, because it's uncertain whether post this commitment shown by Nancy Pelosi as Speaker of the House that it actually happened, that the US will come to the rescue when she's not part of the party in power.
Okay.
I wanted to add one thing. I mean, I agree with Pamela's comments and would have said something similar. In a year's time, we're going to be talking about the 2023 U.S. election. Where I'm a little more hesitant. I think one of our earlier comments was about invasion of Taiwan, and it wouldn't happen near term. And I think one thing that I've kind of pondered and struggled with is, how do we decouple two economies that are so coupled? Typically, you think of wars in the past where one of the countries is a commodity producer, for example, Russia, and that country's principal export is allowed to continue to flow in the market. I have no idea. I'm pretty confident that something will happen between the US and China over my lifetime. I don't know if it's going to be in 2023 or in 2034 or in 2050. But I think it's probably something that we need to be thinking about, because I think political establishments in both countries are thinking about how to insulate their economies and reduce that risk. And so I think it does have to be kind of on our immediate, list of considerations.
Yeah, I would agree with that, Jean. If I could just quickly jump in and say that we do, a lot of companies have been coming to us to map out those scenarios of what a 10-year horizon looks like, and whether the question of whether they do need to start thinking about reorganizing their companies so that there are separate entities for US and China if they've not already done so. But if that's not possible, then looking at how they can strengthen their geopolitical resilience in the country. So do they need to fund more on renminbi, for example, because they're worried that capital controls will mean, if it comes down to it, sanctions will mean that they won't be able to take out any cash. So all of that planning is happening in the event that really, really strong sanctions come down onto China and prevent investment from flowing in and out. But I would say that planning needs to happen, but our view is still that there will be many more trigger points, as well as many more indicators that we are heading that direction before we actually move there.
Thank you, Pamela. So we're coming to the end of our time. I will ask every panelist, each panelist, to give us a one-word association with risk 2023. So you have a minute or two to think about that while I take the last question from the Q&A box and give it to John. John, the question is about financial regulation, and what do you think is the effectiveness of stringent separation of deposit-taking institutions from investment banking across the world? Do you think the two should be separated? Does it matter? Does it not?
I think it creates the illusion of control, because it gets in the way of how a financial institution operates. And the more the government authorities tell banks what to do and how they should segment their businesses or segment their business into categories, the more inefficient the institution and the system becomes. So I think ring fencing is the wrong solution to the problem.
Wow. Okay.
Can I just make one comment in response to John? I mean, I guess, from someone who's, been involved in markets for a long time, I think of the financial system as, a very complex system, and it's only as strong as its weakest link. And right now, I don't think it's really the banks that are the weakest link. I think the risks have kind of migrated, and the challenge that you have in designing optimal regulation is thinking about where the risks spill over to. And it does seem like those risks have moved around quite a bit over the last 15 years.
I would disagree with you, but we have no time.
We do. You can disagree for a minute.
No, I mean, the financial system is an infinitely complex phenomenon. I think it's the most complex thing human beings have ever created. And trying to target one part of the risk spectrum with regulations, which are inevitably inflexible and can't move, all it accomplishes is shifting the risk somewhere else out of sight of where the authorities are looking. Instead of trying to regulate every single bad behavior, it's much better to make the system more resilient, which in my view is based on making institutions diverse, so you get shock absorption. Focusing on mitigating individual risks is counterproductive in my view, but I think we are out of time here.
Okay, well, that's I wish we had picked up this question earlier. That would have been fascinating, but it's been fascinating nonetheless. So thank you to all of you, to the distinguished panel and to members of the audience. If I could go around and ask, have I lost you? Are you still there?
We're here.
We're here. Yeah.
All right. So if I could go around and ask you, please, for that one word that you think captures and characterizes risk 2023. Who would like to? Virginie, would you like to go first?
Yeah, I'm fine. My word is volatility.
Volatility. Thank you. Pamela.
My word is dynamic.
Dynamic. John.
Politics.
Politics. Okay, and Jean.
Disinflation.
Disinflation.
Inflation down.
Ooh, okay. I wasn't expecting that. Volatility, dynamic politics, and disinflation. So with that, we have truly come to the end of our time. So thank you all once again. And thank you to the members of the audience. And I hope to see you all again next time. Thank you and take care. Bye-bye.